Receivables, Chapter 8. Learning Objectives. 1. Describe accounts receivable and how they occur and are recorded. 2. Apply the allowance method to account for uncollectible accounts receivable. 3. Estimate uncollectible accounts receivable using approaches based on sales and accounts receivable. 4. Describe and record a short-term note receivable and calculate its maturity date and interest. 5. Calculate accounts receivable turnover and days sales uncollected to analyze liquidity. 6. Explain how receivables can be converted to cash before maturity. Accounts receivable. Arise from credit, non-cash sales to customers, often referred to as trade receivables. Other receivables include interest receivable, rent receivable, tax refund receivable. Companies selling on account need to maintain a separate account for each customer, account for bad debts. Example, TechCom has the following accounts receivable balances at June 30th. Exhibit 8.2. Balance of controlling account in general ledger agrees to total of accounts receivable subledger. Accounts receivable, Exhibit 8.3. Balance of controlling account in general ledger agrees to total of accounts receivable subledger. Credit risk analysis accounts receivable. 1. Employing credit, scoring models. 2. Using the latest technology to make informed credit granting decisions. 3. Adopting technology to improve the collection process. 4. Monitoring the macroeconomics environment such as debt levels, interest rates, employment, and profit levels. Valuing accounts receivable. Some customers who are granted credit do not pay what they promised. The accounts of these customers are called uncollectible accounts or bad debts. Valuing accounts receivable. Methods for writing off bad debts. Allowance method satisfies GAAP. Direct method does not satisfy GAAP. Allowance method, 2 approaches. 1. Percentage of sales, or the income statement approach. Calculates bad debt expense for the period. 2. Accounts receivable or balance sheet approach. Calculates the required balance in allowance for doubtful accounts. It's calculated as a percentage of total accounts receivable or calculate using an aging analysis. Allowance method. The matching principle requires that bad debts expense be matched and reported in the same period as the sale that generated the receivable. The allowance method satisfies the matching principle by recording any estimated bad debt expense connected to the current period sales in the same period the relative revenue is earned. Recording estimated bad debt expense. Adjustments for bad debts are made at the end of the accounting period by recording and adjusting journal entry. Adjustments use a contra asset account called allowance for doubtful accounts. Recording estimated bad debt expense allowance method. Example, the estimated bad debts for TechCom is $1,500. The period end entry to record bad debts is bad debt expense $1,500, allowance for doubtful accounts $1,500. An allowance account is used since we do not know which customer accounts will be uncollectible. Writing off a bad debt allowance method. Example, a specific customer's account, Jack Kent, is considered uncollectible. The entry to record the write-off is allowance for doubtful accounts $520, credit accounts receivable Jack Kent $520. Note that there is no expense recorded when the account is written off. The estimated bad debt expense was previously recorded. General ledger balances. Bad debt expense $1,500, allowance for doubtful accounts $1,500, to record estimated bad debts. Allowance for doubtful accounts $520, accounts receivable Jack Kent $520, to write off an uncollectible account. Accounts receivable balance debit $20,000, credit $520, debit balance $19,480. Allowance for doubtful accounts, credit $1,500, debit $520, balance credit $980. Realizable value before and after write-off. Accounts receivable balance $19,480, allowance for doubtful accounts $980. Before write-off, December 31st, the estimated realizable accounts receivable is $18,500, and after write-off, January 23rd, the estimated realizable accounts receivable is $18,500. Recovery of a bad debt allowance method. Example: Jack Kent pays his account in full after the account has been written off. 2 entries are needed to record the reinstatement of the account and the subsequent collection. The 2 entries are debit accounts receivable Jack Kent $520, credit allowance for doubtful accounts $520, to reinstate customer's account. Debit cash $520, credit accounts receivable Jack Kent $520, to record collection of account. Estimating bad debts expense, acceptable methods. 1. Percentage of accounts receivable. 2. Aging of receivables. 3. The percentage of sales. Percentage of accounts receivables. This method assumes that a percentage of accounts receivable is uncollectible. Bad debts expense is computed with 2 steps. 1. Total dollar amount of all outstanding accounts receivables is multiplied by an estimated percentage for uncollectible accounts. 2. This amount is the new balance required in the allowance for doubtful accounts. Prepare the entry to adjust the existing balance to equal the new balance required. Percentage of accounts receivable. Example: Modern Office has $50,000 of outstanding accounts receivable on December 31st. It estimates 5% of outstanding receivables will not be collectible. Therefore, they want the allowance for doubtful accounts to have a $2,500 credit balance, $50,000 times 5%. Before they can do the entry, they need to know the unadjusted balance in the allowance for doubtful accounts. Modern Office has a $500 credit balance already in the allowance for doubtful accounts. The adjustment required to make allowance for doubtful accounts equals to $2,500 the entry required for $2,000, $2,500 required balance, $500 existing credit balance. Bad debt expense $2,000, credit allowance for doubtful accounts $2,000, to record estimated bad debts. Aging of accounts receivable approach assumes that the older the account receivable, the more likely it will become uncollectible. Steps. 1. Group accounts based on how much time has passed since they were created. 2. Estimate rates of uncollectibility for each group. 3. Apply rate to each group to get the required balance for the allowance account. Example: At December 31st, the receivables for decor were classified as follows. So they have current 1 to 30, 31 to 60, 61 to 90, or over 90 days. Using estimated bad debt percentages, Decor would calculate the estimated uncollectible amount as follows. So they decided 2% for current debt, 1 to 30 days is 5%, 31 to 60 is 10%, 61 to 90 is 25%, and over 90 is 40%. So for example, 1,000 times 40% equals 400. They add each up and it comes to 2290. Decor's unadjusted balance in the allowance account is a debit of $200. The previous computation shows the desired balance is $22.90. Therefore, the adjusting entry is the difference, $22.90 minus $200, so it's $24.90. I meant to say you have to add the $200, not minus it, because the $200 is on a debit balance this time. So the adjusting entry would be debit bad debt expense, $24.90, and credit allowance for doubtful accounts, $24.90, to record estimated bad debts. Percent of sales approach, also referred to as the income statement approach, based on idea that a percentage of a company's credit sales are uncollectible. The primary focus is on matching bad debts expense with credit sales. Under this approach, bad debt expense is computed as follows: current period sales times estimated bad debt percentage equals estimated bad debts expense. Example: Musicland has credit sales of $400,000 and estimates 0.6% of these sales will not be collectible. Estimated bad debts expense is calculated as $2,400, which is $400,000 times 0.6%. The period end adjusting entry would be debit bad debt expense for $2,400, credit allowance for doubtful accounts $2,400, to record estimated bad debts. Approaches to estimated bad debts. Income statement approach. Percentage of sales. Emphasis on matching sales and bad debt expenses. The balance sheet approach. Balance sheet focus. Percentage of receivables. Emphasis on realizable value. Accounts receivables total and allowance for doubtful accounts. Balance sheet focus. Aging of receivables. Emphasis on realizable value, accounts receivable by aged category, and allowance for doubtful accounts. Direct write-off method, sometimes used as an alternative to the allowance method when uncollectible accounts are not material. The loss from an uncollectible account is recorded when it is determined to be uncollectible. This method does not satisfy the principles of faithful representation and matching. Example: a specific customer's account, Jack Kent, is considered uncollectible. The one entry to record the write-off is debit bad debt expense $520, credit accounts receivable Jack Kent $520. Mini quiz. On October 29, 2020, TC Company concluded that a customer's 4,400 accounts receivable was uncollectible and that the account should be written off. What effect will this write-off have on TC Company's 2020 profit and balance sheet totals, assuming the allowance method is used to account for bad debts? A. Decrease in profit, no effect on total assets. B. No effect on profit or on total assets. C. Decrease in profit, decrease in total assets. D. Increase in profit, no effect on total assets. E. No effect on profit, decrease in total assets. The answer is B, no effect on profit or on total assets. Debit allowance for doubtful accounts, $4,400. Credit accounts receivable, $4,400. Short-term notes receivable. Promissory note. A written promise to pay a specified amount of money either on demand or at a definite future date. Short-term notes receivable. A promissory note that becomes due within the next 12 months or within the business's operating cycle if greater than 12 months. Usually interest-bearing. Interest rates are stated on an annual basis. Interest is calculated as followed. Interest on a 1,000 6% 6-month note is calculated as do 1,000 times 6%. That will give you the interest expense for the year. Then multiply that by 6 out of 12 months to give you the interest expense per month. Example, on July 10th, TechCom receives a 1,090-day 6% promissory note at the time of a sale. The cost of sales is $630. The entry to record the transaction would be notes receivable $1,000, credit sales $1,000, debit cost of goods sold $630, credit merchandise inventory $630. On October 8th, TechCom receives payment in full of 1,090-day 6% promissory note signed on July 10th. TechCom's year end is December 31st. The entry to record the transaction would be cash $1,015, credit notes receivable $1,000, credit interest income $15. 1,000 times 6% times 90 divided by 365, which equals 15. So this time we just did the note over days instead of months. On December 16th, TechCom receives a 3,060-day 6% promissory note and 1,000 cash to settle a 4,000 past due account. The entry to record the transaction would be debit cash $1,000, debit notes receivable $3,000, credit accounts receivable $4,000. On December 31st, 15 days after the note is issued, an accrual for interest earned on the note is made. The entry to record the accrual would be interest receivable 7.4, interest revenue 7.4. So that's 3,000 times 6%. That will give you the annual interest multiplied by 15 over 365 days. On February 14th, the 60-day note matures. The entry to record the honoring of the note would be debit cash 3029.59, credit interest revenue 22.19, credit interest receivable 7.4, credit notes receivable 3,000. 3,000 times 6% times 60 over 365 equals a total interest of 29.59. And we broke that down between what you recognized in your year end, which was the 7.4. So you have to reverse out that interest receivable. And then the difference is you can recognize interest revenue in this period. Sometimes the maker of a note does not pay the note at maturity. This is known as dishonoring the note. The payee should use every legitimate means to collect. The note receivable and uncollected interest income is charged to an accounts receivable in the name of the maker of the note. Review. Explain why the allowance method satisfies the general accepted principles of faithful representation and matching. The allowance method ensures that the asset, accounts receivable, and the reported profit are not overstated. In this way, it accomplishes the requirements of the faithful representation principle. The allowance method recognizes the bad debts expense in the same period in which the related credit sales were recognized. In this way, it accomplishes the required matching of expenses with the period in which the revenue was recognized. Review. Explain how to record the receipt of a note receivable. A note is recorded by entering the total amount borrowed, principal, as a debit to notes receivable and as a credit to the account representing the asset or service exchanged for the note. Financial statement analysis. The quality, likelihood of collection, and liquidity, speed of collection of a company's receivables may be assessed by calculating 1. Accounts receivable turnover ratio. 2. Days sales uncollected. Financial statement analysis. Accounts receivable turnover equals net sales divided by average accounts receivable. Days sales uncollected is accounts receivable divided by net sales times 365. Converting receivable to cash before maturity. Appendix 8A, and we're actually not going to be focusing on Appendix 8A, so I'll just skip this. Summary. 1. Describe accounts receivable and how they occur and are recorded. 2. Apply the allowance method to account for uncollectible accounts receivable. 3. Estimate uncollectible accounts receivable using approaches based on sales and accounts receivable. 4. Describe and record a short-term notes receivable and calculate its maturity date and interest. 5. Calculate accounts receivable turnover and days sales uncollected to analyze liquidity. And don't worry about number 6. End of chapter.